Welcome to Chapter 7. In this chapter, we're going to talk about reporting cost of goods sold and the inventory on a company's financial statements. There's two main goals of inventory management, and they are common sense. The first is we want to make sure we have enough inventory on hand to meet customers' needs, because if we run out of inventory, it's going to piss our customers off, and they may go to our competition. At the same time, we don't want to have too much inventory on hand because it costs money to carry that inventory. In addition, we have storage costs, potential financing costs, and obsolescence costs. Storage costs deal with the cost of having a warehouse to hold the inventory, the utilities costs, and other maintenance costs associated with maintaining the warehouse. Obsolescence would be the inventory spoiling or becoming no longer useful. For instance, technology experiences a high level of obsolescence. Technology changes so often that inventory may become obsolete very quickly. So we don't want to have a whole lot of inventory on hand because by the time we sell it, it may not be current anymore and customers therefore won't want to purchase it. And then inventory costs money, obviously, to purchase. So if we have a whole bunch of inventory, we may have to finance it, and that's going to cause us to incur interest costs. So it's kind of like a juggling act. You have to figure out how to have enough inventory on hand so that our customers will be happy and they'll have the inventory available when they need it. And then you also have to figure out a way to minimize the cost of carrying that inventory. So basically, you want to have the inventory just in time for when the customer demands it. Inventory is going to show up in two places on the financial statements. When it's unsold at the end of the year, it's going to show up in inventory on the balance sheet. And then as we sell that inventory, it shows up as an expense known as cost of goods sold on our income statement. The key in this chapter is going to be to figure out how to allocate the inventory between the amount left over and the amount that is included in cost of goods sold. So the first thing we're going to do is talk about how we record the cost of inventory when we purchase it. There's two types of companies that deal with inventory: merchandisers and manufacturers. Merchandisers simply buy and resell inventory. These would be companies like Amazon, Walmart, Target, and any other retailer. Manufacturers, on the other hand, are companies that produce the goods. So they're going to have three different types of inventory. They're going to start with raw materials inventory, and then as they start putting the materials together and making their final product, it becomes what's referred to as work in process. That's inventory that's not quite complete. So if you think of an iPhone, the raw materials might be glass and metal and circuitry, and then work in process would be a phone that isn't fully completed yet. So maybe it's missing the screen. And then finished goods inventory would be the completed final product or finished phones in my example. Inventory is initially recorded at cost, but what is cost? Up to this point, if we talked about buying inventory, we basically said we purchased inventory for $1,000 and that was all there was to it. That's how we recorded it. But in the real world, there are a lot of costs associated with getting that inventory. Instead of memorizing a big list, just think of it in terms of answering this question. Did I need to incur the cost to get the inventory ready to sell? If yes, we include the cost. If no, we exclude the cost from inventory. So as an example, if I'm buying inventory, obviously the purchase price or invoice price is going to be included. In order to sell the inventory, I need it, which means I need to pay for freight in, which is shipping costs. So that would be included in the cost of inventory. If I need to inspect it before I sell it to make sure it's safe, that's also going to be a cost that gets included in inventory because, again, I needed to incur it in order to get the inventory ready to sell. If I, say, wrap it in some type of plastic to make a package ready to sell to the customer, that would be a preparation cost, which again would be required in order to get the inventory ready to sell, so it would be included. Purchase returns and allowances. If we return the goods, they're no longer ours, so that would be taken away from our overall inventory cost, as would any purchase discounts. A purchase discount we'll talk about the end of the chapter, but that's like the sales discounts we learned in chapter 6, the 210 net 30 stuff, where we get a discount for paying quickly. Obviously, if we get a discount for paying quickly, it reduces the cost of our inventory. So that's why returns and discounts reduce the overall inventory cost. Basically, any cost that's associated with selling the product or shipping it out to the customer is not necessary to get the inventory ready to sell. So those costs would be included in selling and administrative costs. They would not be part of inventory. So you got to know where to draw the line. And the best way to do it is to ask yourself the question, did I need to incur the cost to get the inventory ready to sell? So do I need to incur shipping costs out to the customer to get the inventory ready to sell? No. I need to incur shipping costs to sell the inventory, but not to have it ready to sell. Don't confuse those shipping costs out to the customer with freight in costs, which are costs to get the inventory delivered to us, the business. Freight out costs would be the cost to deliver it to customers. Freight in is included because we need the items in our warehouse to sell them. Freight out would be excluded because we don't need to ship goods to the customer to have the inventory ready to be sold. Incidental costs such as inspection and prep costs, if they're very minor, meaning in accounting terms not material, which means they're not big enough for anybody to care, we can just expense those and not include them in the cost of inventory for simplicity. But if the amounts are significant, we should include them in our inventory cost in order to be in compliance with GAAP. Remember, with GAAP, we only have to follow the rules that you're taught in this class when the amounts are big enough for people to give a shit. Yep, that's right. I said give a shit. If people don't care about it, it doesn't matter. So we don't need to follow the rules. We can do whatever we want. So it's only when the amounts are material that we have to really focus in on following all of the rules. Most companies, therefore, are going to report their inventory costs at the invoice price, less any returns and discounts, because all the inspection and preparation costs are usually insignificant and they would just be expensed when they're incurred. It's important to understand that inventory costs first become an asset and they only become an expense once they're sold. So for a merchandiser, when we buy inventory, it becomes merchandise inventory, which shows up on our balance sheet, and it only gets expensed when it's used. Remember, we expense things when we use them. How do we use inventory? We sell it. So when we sell it, the inventory becomes an expense on the income statement known as cost of goods sold. For a manufacturer, manufacturers are going to have raw materials, WIP, and finished goods inventory. In order to make their products, they add labor and overhead costs in order to convert it from a raw material into a finished good. But the bottom line is all of those items, those costs associated with making the inventory, go into one of the 3 inventory accounts on the balance sheet and will only get expensed when those final goods are sold. We'll focus more on manufacturing and managerial accounting. Our focus in financial accounting really will be on the merchandiser. In order to calculate our inventory, it's going to be our beginning inventory plus our purchases, which gives us our goods available for sale. And then with those goods, logic tells me I have 2 choices. I either sell them or I don't. If I sell them, they become cost of goods sold. If I don't sell them, they become ending inventory. Those are the only 2 choices. Instead of this visual, we could express it in an algebraic formula where beginning inventory plus purchases equals our goods available for sale minus our ending inventory equals our cost of goods sold. This is how I abbreviate each of these items, so you should get used to that for future discussion. So beginning inventory is BI, purchases is PERCH, COGAS stands for cost of goods available for sale, ending inventory is EI, and then cost of goods sold is COGS. You could also change that equation to be beginning inventory plus purchases minus ending inventory equals cost of goods sold. You'll notice the abbreviations the book uses are slightly different than mine, but we could use that formula, basically eliminating the subtotal cost of goods available for sale, which might make some of the calculations in the chapter a little easier to do. There's two overall types of inventory systems, perpetual and periodic. Visualize yourself at the grocery store. To help you visualize, let me give you some sound effects. Boop, 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 boop. That booping sound is the sound of items getting scanned at the register. When you hear that boop sound, it's recording the sale of the inventory, which is what you see. You see the amount you have to pay the supermarket or the store for the goods you're purchasing. But at the same time, it's also recording the cost of goods sold and taking that inventory off of the books. That's happening in the background. That is what a perpetual system does. It's constantly updating inventory. And a perpetual system is going to require two entries, which we've already discussed before. The first entry is the sale, which will involve a debit to accounts receivable or cash, making assets go up, and a credit to revenue. That's the amount you would see as the customer, because that's the amount you have to pay. And then part B would be to record the cost of goods sold associated with that sale. That's the cost for Target or Walmart to sell you those goods. So the expense would go up and the inventory asset would go down. That's happening with every boop that you hear. Both of those entries get recorded. In a periodic system, we don't keep inventory up to date. Instead, when we record the sale, we just do part A, and part B doesn't get recorded. Instead, we wait till the end of the period, and we periodically count the inventory on hand, and we assume that everything that's gone must have been sold, and then we record an adjustment for cost of goods sold. When we do journal entries in this class, we're going to focus on the perpetual method, which involves these two entries to record the sale. And then, though we've covered it in other chapters, the purchase of inventory would be a debit to inventory to make it go up, and a credit to cash, which makes assets go up, or account payable if you don't pay for it right away, which makes your liability go up. So when we purchase inventory, we record that inventory right away at the time of purchase, and then when we sell it, we record both the sale and the cost of goods sold and the associated inventory reduction. That's what happens in a perpetual system, and as far as journal entry goes, that's going to be our focus in this class. A periodic system does the journal entries a little differently, but because a point of sale system, the boop, boop, boop system, is so cheap, most companies use a perpetual system, so that'll be our focus when it comes to recording journal entries.